So, Mark, in the search for new potential sources of return, investors are now looking past more traditional investments, including to structured products.
Yes, that's right, Anna. Structured products can be a versatile tool in an investor's portfolio. They're packaged products that derive their returns from a range of underlying assets, including equities, fixed income, commodities, currencies, and alternative assets. Unlike more traditional investments, some structured products can also potentially incorporate some form of capital protection or risk management, subject to certain risk factors. They can be designed to suit specific types of investor risk profiles. They're typically structured using derivative instruments, such as options or swaps, with the aim of achieving quite different risk-return outcomes.
Previously, you've spoken about two key differentiating factors that separate these from traditional investments. Could you outline those for us?
Yes, well, firstly, structured products are customizable and can be aligned with a wide range of investor risk appetite and investment goals. For certain investors, other legislative provisions inform the type of structured product they can avail of. Whether it's capital protection, enhanced return potential, income generation, or exposure to a particular asset class. A real difference is their ability to generate potential returns in a range of different market environments, including positively and negatively trending markets. Choosing the right structured products can allow investors to potentially fine-tune their portfolios to match their market view, risk tolerance, and financial aspirations. Secondly, they can change the risk and return profile otherwise facing investors and potentially provide outcomes that may not be attainable through standard investments. For example, a structured product may offer capital protection or a minimum return subject to certain risk criteria, whilst also participating in the upside potential of the stock market, thereby potentially appealing to risk-averse investors who have an appetite for some growth. Or, for investors seeking higher yields, there are structured products available which are higher risk and with the potential for attractive returns without requiring significant market growth to deliver these. There isn't a one-size-fits-all here, and it's important to consider an investor's overall experience, financial needs, and risk appetite before investing.
And so structured products are clearly complex and not for everyone. What would you say are the main factors a potential investor may want to consider?
Yeah, look, firstly, it's important to say that as with all investment products, structured products carry varying levels of risk up to and including the potential loss of capital invested. When considering investing, I think potential investors should consider a number of factors. For example, do they want capital protection for this element of their portfolio? Not all structured products have the potential for capital protection, or it may be limited, meaning that there is a risk of capital loss. Investors should only choose products with a risk profile that matches their experience, risk appetite, and their needs. They should also be comfortable that the delivery of the defined returns and any capital protection is dependent on the financial strength of the institution providing the product. And if that institution fails, they may suffer a partial or a total loss of their investment. Investors should also be prepared to invest for the full recommended holding period. Structured products are typically fixed-term investments and may not be easy to sell or to exit before their stated maturity date. Whilst structured products can derive their return from equity markets, investors won't benefit from dividends, so if they're seeking the potential for dividend income, they may prefer to invest directly in stocks or in dividend-paying funds. As you say, these are complex products and their features, valuation and performance may not be easy to understand. So investors should always seek financial advice which takes into account their risk appetite, liquidity and protection needs, and also their knowledge and experience of similar products before investing.
And finally, in terms of our wealth allocation framework, can you discuss exactly where this type of investment may potentially fit?
Davy's wealth allocation framework is about aligning a client's portfolio with their objectives and has three main elements. Firstly, liquidity. This is the element of a portfolio designed to meet short to medium-term needs and includes money market funds and bond investments, for example. Secondly, core. This is a range of diversified portfolios in the Davy framework that invest across a variety of asset classes for the potential for above-inflation returns. These holdings are tailored based on investors' time horizons and capacity to take risk. The core portfolio is designed with the intention of delivering on a client's lifetime wants. And lastly, satellite. And this is where structured products can potentially fit. In general, satellite holdings are designed to meet aspirational and growth objectives, and holdings may have reduced liquidity and diversification versus core holdings, for example. However, they may provide differentiated return sources or access to thematic investments not readily available through more traditional investment types. An advisory capital appreciation or CAPAP mandate is required for all structured product investments. This includes both higher and lower risk products given the intended holding period. We generally advise that customers consider their allocation to structured products over a 12-month period to capture time, counterparty and index level diversification. Subject to suitability, Davy offers structured products as part of its advisory service, and if an investor is considering such an investment or wants to find out more, a meeting with their advisor is the best starting point.
Thank you, Mark.
Thanks, Anna.